Welcome, and thank you for tuning in to ESG Talks, a KBRA podcast series focusing on environmental, social, and governance (ESG). This podcast series highlights various ESG hot topics and includes commentary from prominent voices within the ESG community. Hi, everyone. This is Emilie Nadler from KBRA'S ESG team. I'm happy to be joined today by Pat Welch, KBRA'S Chief ESG and Ratings Policy Officer, as well as Van Hesser, KBRA'S Chief Strategist. Thanks, Pat and Van, for coming on to discuss KBRA's approach to ESG integration in our credit analyses and research. So, as you both know, ESG investing has really exploded over the past few years, and I think that we've seen that the pandemic has really only accelerated this trajectory. Financial market participants are interested in accessing better and more consistent ESG information to make investment decisions, and are also increasingly looking to rating agencies to understand the relevance of ESG to financial metrics and the risk of default. So with that backdrop, I'm just going to dive right into the questions. So Pat, I'd like to start by asking you to give a little bit of an overview about how KBRA thinks of ESG issues in the context of corporate, financial, and government, so our CFG credit ratings. I think it would be especially helpful for our audience to understand why our approach is centered around the management of ESG issues.
Sure. Thanks, Emily. At KBRA, we believe most ESG issues that intersect with credit risk analysis are inherently management issues. And for this reason, we call our ESG approach in the CFG space ESG management. In the world of credit risk analysis, ESG can't be done as a simple scoring exercise. It requires thoughtful analysis of myriad, often interconnected risk management issues, some of them very direct and clear, and some of them more indirect. Now, our approach gives transparency into the real world and into the dynamic risks that ESG presents to entities. Some risks may be near term and some may be longer term, but entities preparing for risks and opportunities will likely have stronger management profiles, and this has always been a key component of KBRA's risk analysis for CFG issuers. Analyzing management's ability to respond to ESG issues helps to get at the interconnectedness of ESG considerations. Many environmental and social issues, for example, are inextricably linked, so it really helps to think about it in terms of a holistic management of ESG risks, because decisions on one issue often have ramifications on others. Consider, as an example, a U.S. state that's investing in flood prevention measures because of an increased frequency of high-intensity storms. Mitigating the environmental risks like this may be obvious and of course, absolutely necessary as a response. But the question is, what are the ramifications of that decision and the way you go about that decision? Are there opportunity costs associated with that decision? For example, maybe it leads to a reduction in public health spending. So it's critical to understand management thinking around such issues and the ramifications of whatever decisions it makes, what the cost-benefit analysis is, how is it prioritizing, is it creating flexibility to respond to changing conditions, and other things like that. Now, across the landscape of CFG issuers and sectors, we've identified three main ESG factors that we believe have the highest likelihood of impacting credit risk analysis. These three factors are climate change, stakeholder preferences, and cybersecurity risk. And we're going to delve into all three of those in a bit. But it's important to understand broadly that the risks each sector and issuer faces are unique and distinct. So these three categories are not exhaustive by any means. KBRA evaluates many other sector and issuer-specific ESG factors during the rating process. And I want to also make one last point. I want to emphasize that ESG issues are not static. And they're evolving rapidly and in some cases dramatically. So some ESG considerations may become more or less impactful to credit over time.
Thanks for that, Pat. And I think that last point is so important and really reinforces why we focus on management, because these issues are changing so quickly. So that's important to highlight. So Van, turning to you now, I want to understand why KBRA decided to incorporate ESG directly into our credit rating process and not offer an ESG scoring product.
Yeah, thank you for that, Emily. Like a lot of the things that we do at KBRA, we really did extensive investor outreach. when thinking through this topic, right? So scoring systems, we think, often include irrelevant data scraped from public sources. And we talk to investors, they oftentimes would cite the opacity of the data, subjectivity that's introduced in which data fields are included. There's inconsistency across some of these scoring models. And of course, from a rating agency perspective, there's a conflict of interest issue. So we didn't get a lot of impetus from investors that they needed yet another credit rating agency weighing in with an ESG scoring model. We also worried about, as investors have with us, that there's the potential for greenwashing across all of this data gathering. So you heard what Pat talked a bit about, and I think it applies as we thought through this decision that we believe that values-based judgments are best left to investors, not rating agencies, right? We focus on what drives default risk, right? So we see scoring products from rating agencies to be at best a distraction and at worst a distortion to our mission, right? Which is rigorous credit analysis. Now, we do understand investors are seeking better and more consistent data from ESG issues, and we're committed to improve disclosure from our issuers, and most importantly, analysis on how management is addressing those issues. You heard Pat talk a lot about that. It really is a critical issue from our perspective. Our extensive interactions with management reveals how ESG factors, the risks and the opportunities are being addressed, right? Those are the things that can become material to credit, and those things we care about and reflect that in our ratings.
Great. Thank you for that, Van. So Pat, I want to go back to something you mentioned, which is that we've identified 3 overarching ESG factors that we see intersecting with credit for most issuers across the CFG space. And so those are climate change, stakeholder preferences, and cybersecurity. Can I ask you to do a bit of a deeper dive into climate change and the kinds of topics our analysts think about when they evaluate an issuer's exposure to and management of climate change risk?
Sure, yes. Thanks, Emily. As the effects of climate change evolve and become more severe, issuers are increasingly facing an array of challenges and really potential opportunities, frankly. The short and long-term risks and opportunities created are challenging to assess, and they involve scenario analysis, projections related to global efforts to reduce global greenhouse gas emissions, projections on stakeholder pressures and changes in demand, and they may involve predicting policy responses. So it's quite challenging. So KBRA considers scenario analysis, mitigation planning, and related environmental disclosures as super important and increasingly important for most CFG issuers. KBRA analysts examine, where relevant, an issuer's exposure to both physical and climate transition risk. Physical risks include extreme weather, such as drought, sea level rise, other climate change-driven factors, or events that directly impact assets or business operations. Transition risks, on the other hand, are indirect and relate to how able an entity is to shift to a lower carbon economy driven by environmental regulations, supply and demand changes, and increased reputational risk. For physical climate risks, KBRA analysts evaluate an issuer's analysis of the potential impact on relevant assets such as operating facilities, revenue-generating assets, and even financial assets such as insurance policies and business loans. And for transition risks, KBRA believes it's important to understand management's awareness of and the planning for the potential effects of the global shift to low-carbon economy, such as expansions in climate-related law or other regulations that impact operations, capital plans, and consumer demand. KBRA believes that the process an issuer uses to analyze its exposure to climate change is critical because this provides insight into the robustness of its risk management practices.
Great. Thank you for that, Pat. That's really helpful and leads well into my next question for Van. So as Pat has mentioned, stakeholder pressure is really our focus for social. But what do we mean by that? And why is that the anchor for our commentary on the social aspect of ESG?
Yeah, thanks for that question, Emily. So we've talked about the importance from a credit perspective of how management addresses ESG issues, right? So think back to 2019, 181 CEOs of the Business Roundtable, including Jamie Dimon and Tim Cook, espoused the importance of stakeholder capitalism, right? This, along with Larry Fink's annual letters at BlackRock, have been seminal moments in the shift in American business from shareholder capitalism to stakeholder capitalism. Now, to maximize firm value, you have to pay attention to not only shareholders, but also employees, customers, suppliers, regulators, and policymakers. In the case of public finance, voters, right? So the social considerations that we examine from an ESG perspective cut across this expanded list of stakeholders. Now, this introduces a whole new set of management challenges, right? Stakeholder interests are complex and oftentimes competing. Like, for example, take a midstream energy company facing delays in building a pipeline due to community opposition. Management has to figure out how to balance social concerns with the economic and political realities. That calculus is quite different than simply maximizing profit, right? And that is management's challenge. And it's also our challenge, right? The analysis is not simply a function of leverage and coverage ratios. So analyzing competing interests of stakeholders becomes important, right? And I'd like to highlight a piece that we recently published on Texas Senate Bill 19, which requires firms doing business with the state entities to certify that they do not discriminate against firearm or ammunition industries. Now, something deeply important to some citizens, but deeply offensive to others. And state officials are going to need to strike a balance or take a stand. So this is a complex set of analysis, but it's one that's increasingly relevant in the ESG world.
That's great. Thanks for that plug, Van. I think that's important. I would encourage people to visit esg.kbra.com to read that research piece, as well as more that delve into this idea of stakeholder pressures and the competing interests that are often at play and how it can affect credit. So, Pat, lastly, moving on to governance. Why is cybersecurity important to credit ratings, and what kinds of topics do our analysts think about when they're analyzing an issuer's exposure to and management of cybersecurity?
Yeah, this is a big and growing issue. Organizations, regardless of size and industry, are at risk of cyber attacks, as we all know. And as issuers become more reliant on technology, cybersecurity and information management have the potential to affect issuers across all CFG sectors. And we also know this is a key ESG factor that investors are increasingly evaluating. To give you a sense for size, for scale, and evolution here, in 2020, the FBI received nearly 800,000 cybercrime complaints to the tune of losses exceeding $4 billion. And that was a 69% increase over 2019. The losses incurred after a cyber attack are not just monetary. Sensitive data and the entity's reputation can also be compromised. Some recent high-profile cyber attacks include the ransomware attack on the Colonial Pipeline, and that created severe fuel shortages across the East Coast. There was a data breach of more than 500 million Facebook users worldwide. Hackers tried to assess Pfizer's data related to COVID-19 vaccinations, and the breach of several federal agencies known as the SolarWinds. That went undetected for months. And in fact, this morning, I just noticed in the news that same Russian group behind that is staging more attacks on US tech companies as we speak. So KBRA believes this is an important credit risk consideration. And where it's relevant, we evaluate the strength and the ability of the issuer's cybersecurity systems to protect consumer data and prevent data breaches and malware and ransomware attacks. Areas of inquiry that KBRA pursues on cybersecurity can vary considerably based on the issuer and the sector. Does the entity have a dedicated staff to manage cybersecurity systems? Does it follow internationally accepted security standards? Does it have a security awareness program in place? Does it regularly train and test employees on cybersecurity issues? It's also important to note, for issuers who have experienced a cyber attack, it's important really to understand what ramifications of their breach were and what was learned from the experience and how it changed its procedures to prevent future attacks.
Great. Well, I think that's really helpful for our audience to understand why we anchor ESG around these three topics and really how we see it, these three topics as relevant to credit across CFG. So Van, I have one final question for you. As KBRA'S chief strategist, how do you see the importance of ESG to credit ratings over time? And do you think ESG is likely to be a core part of KBRA's strategy going forward?
So yes, Emilie, very simply, if it's important to credit to default risk, it will be incorporated into our ratings. If I think back over the past 30 years and list out forces that significantly influence investor flows, I think of globalization, I think of technology, and I think of ESG. So ESG can materially impact cost of capital, demand for a company's product or service, cost structure, litigation risk, viability of a project, right? We have always factored into our credit ratings things that can materially impact default risk. And we owe it to investors that look to our ratings to not only highlight those ESG elements that are part of an issuer's story, but to also explain how management is addressing those issues. We will continue to communicate those findings in our rating, surveillance, and research reports as we gather data relevant to ESG considerations.
Great. Well, I think that's a perfect way to end. I think we see ESG only growing in importance, especially as the world shifts to a low carbon transition. So I want to thank you both so much for staying on with me to discuss KBRA's ESG approach. I think it will be very informative for our audience.
Thanks, Emily.
Thank you, Emily.
Thank you to Pat and Van for a very interesting discussion. Please email esg@kbra.com with any questions or comments. We also encourage you to visit KBRA's ESG website at esg.kbra.com, where you can find ESG research related to the topics discussed in this episode, further details on KBRA's ESG approach, and other ESG-related media items. You can also join our mailing list to access our ESG Weekly Roundup newsletter. This concludes our episode. Please visit kbra.com to access our other podcast series as well as our ratings and research.